Welcome to Chapter 2. Now that you've built a strong foundation in Forex trading, it's time to dive into the how. How do you actually trade Forex? And more importantly, how do you make the money work for you? In this chapter, we will learn all the essential elements that are key to making money in Forex trading. Let's break it down into the following topics. How to make money trading Forex. Know when to buy or sell a currency pair. What is a pip in Forex? And what is a lot in Forex? Currencies are always quoted in pairs, such as GBP, USD, or USD JPY. The reason they are quoted in pairs is because in every foreign exchange transaction, you are simultaneously buying one currency and selling another. The first listed currency to the left of the slash is known as the base currency, while the second one on the right is called the counter or quote currency. Now let's talk about how you can make money trading Forex by going either long or short. If you want to buy, you want the base currency to rise in value, and then you would sell it back at a higher price. In traders' talk, this is called going long, or taking a long position. Just remember, long dies buy. The other one, going short, or taking a short position. Just remember, short buys sell. All Forex quotes are quoted with two prices, the bid and ask. For the most part, the bid is lower than the ask price. The bid is the price at which your broker is willing to buy the base currency in exchange for the quote currency. This means the bid is the best available price at which you will sell to the market. Now, let's head to another section. Know when to buy or sell a currency pair. First, what drives the value of a currency? If you believe that the U.S. economy will continue to weaken, which is bad for the U.S. dollar, you would execute a buy your USD order. By doing so, you have bought euros in the expectation that they will rise versus the U.S. dollar. If you think that the Japanese government is going to weaken the yen in order to help its export industry, you would execute a buy USD JPY order. By doing so, you have bought US dollars in the expectation that they will rise versus the Japanese yen. If you think the British economy will continue to do better than the US in terms of economic growth, you would execute a BYGBP USD order. By doing so, you have bought pounds in the expectation that they will rise versus the US dollar. If you think the Swiss franc is overvalued, you would execute a buy USD CHF order. By doing so, you have bought US dollars in the expectation that they will appreciate versus the Swiss franc. Next, what is a pip in Forex? You've probably heard of the terms pips and lots thrown around, and here we're going to explain what they are and show you how their values are calculated. The unit of measurement to express the change in value between two currencies is called a pip. If EUR USD moves from 1.1050 to 1.1051, that 0.01 USD rise in value is 1 pip. A pip is usually the last decimal place of a quotation. There are brokers that quote currency pairs beyond the standard 4 and 2 decimal places to 5 and 3 decimal places. They are quoting fractional pips, also called pipettes. For instance, if GBP USD moves from 1.30542 to 1.30543, that 0.0001 USD move higher is 1 pipette. Next, what is a lot in Forex? How many units of currency can we trade? What size positions can we trade and what are they called? In the past, spot Forex was only traded in specific amounts called lots, or basically the number of currency units you will buy or sell. The standard size for a lot is 100,000 units of currency. And now, there are also a mini, micro, and nano lot sizes that are 10,000, 1,000, and 100 units respectively. As you may already know, the change in currency value relative to another is measured in pips, which is a very, very small percentage of a unit of currency's value. What is leverage? You are probably wondering how a small investor like yourself can trade such large amounts of money. Think of your broker as a bank who basically fronts you $100,000 to buy currencies. All the bank asks from you is that you give it $1,000 as a good faith deposit, which it will hold for you but not necessarily keep. Types of Forex orders. Buying and selling currencies can be just as simple with a little practice. First, market order. A market order is the simplest type of trade. It means buying or selling a currency pair at the current market price. This type of order is executed instantly, making it ideal when you need to enter or exit the market quickly. Second, limit entry order. A limit entry order allows you to set a specific price at which you'd like to enter the market. If the market reaches your desired price, the order is triggered and your trade is executed automatically. Then we have stop-loss order. A stop-loss order is designed to limit potential losses by automatically closing your trade if the market moves against you. You set a specific price, and if the market reaches that level, the trade is exited to prevent further losses. Lastly, trailing stop. A trailing stop is a dynamic stop-loss order that automatically adjusts as the market moves in your favor. Instead of setting a fixed price, the stop price trails the market by a set distance. As the market moves in your favor, the trailing stop moves with it, locking in profits while protecting you from a sudden reversal. It's a powerful tool for maximizing gains while minimizing risk. And that wraps up this chapter. We've gone over the essential concepts that will help you navigate the Forex market, providing you with a solid base to grow your trading knowledge. Thanks for joining me, and I'll see you in the next chapter.